Thank you everyone for joining us. We are going to give folks another moment to log in and then we'll get started. Good afternoon and welcome to today's discussion, bringing sustainable investing options to 140 million Americans. My name is Eric Pitt, climate finance consultant with the Ceres Accelerator for Sustainable Capital Markets. I'm thrilled that you're able to join us for this special event that is co-sponsored by the Environmental Defense Fund and USCIF, the Forum for Sustainable and Responsible Investment. We have a lot to get to and a remarkable group of thoughtful and knowledgeable speakers, but let me start with a few brief announcements. First, today's program is being recorded. We will be sharing this with all of you and posting this on our website. Second, we welcome your comments. Please feel free to add questions in the chat. We've also received dozens of questions from the registration. If we do not get to your question during the 1-hour session, we will send a follow-up note, assuming you've registered with your email. Next slide, please. It is a pleasure to collaborate with our partners for today's event. Ceres is a nonprofit organization advancing leadership amongst investors, companies, and capital markets influencers to drive solutions and take action on the world's most pressing sustainability issues. The Environmental Defense Fund focuses on transformative solutions to the most serious environmental problems by linking science, economics, law, and private sector partnerships. USCIF is the leading voice advancing sustainable investing across all asset classes, focusing on long-term investment and the generation of positive social and environmental impacts. Next slide, please. We appreciate the generous support from many donors, including those listed here. Their ongoing support is truly valued. Next slide, please. As you can see, we have a remarkably knowledgeable group of speakers. Our featured speaker today is Ali Khawar, Acting Assistant Secretary of the US Department of Labor, and the man behind the proposed rule we're here to discuss. I'm pleased to co-host today's session with our great partner and friend, Lisa Woll, CEO of USCIF. Lisa will tell you more about our remarkable panelists shortly, but they are John Hoeppner, Head of US Stewardship and Sustainable Investing at LGIM America, Tiffany Reeves, Employee Benefit and Institutional Investor Services, Reinhart, Boerner, Veuren, and Allison, Wielobob, General Counsel of the American Retirement Association. Next slide, please. To provide some context and help emphasize the significance of this proposed rule, I'll give you some following background. ERISA plans hold $12 trillion in assets, of which 401k and other defined contribution plans hold about $8 trillion. Over 140 million American workers participate in these plans. In 2020, new Department of Labor rules all but prohibited plan sponsors from considering climate and other ESG factors in their investment selection and proxy voting. As a result, about 99% of these assets are invested without consideration of climate risk. However, investors broadly acknowledge that climate is a relevant financial risk to the markets, and there is growing and strong grassroots interest in values-oriented investing. Next slide, please. Before we turn this over to our guest speaker, I'm going to read a portion of an opinion piece from the Boston Globe written by Ron O'Hanley, Chairman and CEO of State Street Corporation, one of the nation's largest investors. Our only option is to commit across society to dramatically reduce release of greenhouse gases, building a net zero economy by mid-century. Up to now, retirement plans and investors have been forced to the sidelines. The Department of Labor's new approach will allow holders of this $12 trillion in US retirement savings to consider climate investment risks and opportunities. I applaud the Department of Labor and Secretary Marty Walsh for taking this important action. It will improve the retirement security of Americans as well as the environment. Now I'd like to introduce our featured speaker, Ali Khawar, Acting Assistant Secretary of the Department of Labor. Secretary Khawar has extensive government experience, having previously served in a variety of roles at the department, including as EBSA's Chief of Staff and as a counselor to the 26th Secretary of Labor, Thomas E. Perez. The Secretary and his team at EBSA have worked long hours drafting this important proposal. Secretary Khawar, thank you for your leadership and for joining us today. Over to you.
Thanks, Eric. And I want to thank Ceres and the EDF and USF for the invitation. Happy to be here with all of you today. Although it still feels a little strange to be doing these events virtually, I continue to look forward to the day when we can do these in person. So I wanted to give you a background on kind of the steps that we've taken, but also give you a sense of why we thought it was important to act. Because for those of you that are less familiar with rulemaking, it's a very significant event for an administration to propose a rule in its first year. And here, it was in the first 9 months. The reason for that is that this issue is something that we've been dealing with for a number of years, probably since the mid-90s, and the Clinton administration was where this issue first became very significant and kind of the hot button issue that it has unfortunately become since then. And the question that we've been focused on is really, when someone's investing retirement plan assets, what are the things that are appropriate for them to take into account? And ESG, environmental, social, and governance factors, have traditionally been viewed as falling into this category of what we colloquially, but not very colloquially, refer to as collateral benefits. The concept really has been, going back to the mid-90s, that you have these traditional metrics that you look at that will help you determine how risky or what kind of return an investment might provide you. And once you're done with all of that, then you can take into account these other factors, whether they're environmental, social governance, or other things. That issue has been kind of looked at in succeeding administrations. So in the Clinton administration, the Bush administration, the Obama administration, the Trump administration, and then now the Biden administration. Each administration has put its stamp on these issues. And it's fair to say that in Republican administrations, the tenor of the guidance has been fairly negative in terms of addressing ESG and whether ESG is appropriate at all. And in Democratic administrations, it's kind of been the opposite. Throughout all of this, though, the central premise of the guidance that we've issued has always been that what we refer to as Section 404 of ERISA, the statute that governs private sector retirement plans, that imposes an obligation on fiduciaries, the decision makers. And that obligation is that they need to be looking out for the best interests of the participants and beneficiaries, the people who are ultimately receiving this retirement income. And that best interest is really what is in their direct financial interest. It is that concept of risk and return. And I think, the important context of our proposal are the actions that were taken in the prior administration. In the prior administration, there were 2 rules that were issued. One was on what's called financial factors, but really was a rule focused on the appropriateness of taking ESG into account and making investment decisions. And the second rule was on what's called proxy voting, how you exercise shareholder rights that you have through shareholder engagement, through votes, or however else. there was a proposal, a notice and comment period, and a final rule. And the response to those proposals was pretty negative. And I think people fairly read those proposals as being very anti-ESG in particular and anti-proxy voting. And then there were final rules that were issued in the last couple of months of the Trump administration, which I think, again, in fairness, did move some distance and were read as maybe a little bit more moderate if you read it closely. But people continued to think that, given the backdrop of those proposals, it was quite problematic in terms of the approach that they took. And from the beginning of this administration, this has been a priority area of ours, as I mentioned. In fact, on day one of this administration, President Biden issued an executive order that asked the Department of Labor to look at this issue. There was a second executive order issued in May of this year that again asked us to consider rescinding, repealing, or replacing the Trump administration rules. A big part of our approach to this issue has been to talk to the people that are on the front lines and really to do a lot of listening, because we don't necessarily see things in the same way that people that are making these investment decisions or the people that are advising the investment decision makers do. And so, starting in, I think technically it wasn't January 20th, it was probably January 30th or something like that. But from the very beginning of the administration, we did begin to engage a lot with outreach. A lot of the people that you're going to hear from today are people that we spoke to, and we got a lot of very valuable feedback, which gave us a couple of really important data points and decision points. The first thing that we did was to announce a non-enforcement policy. Essentially, we said that although those rules remain on the books and they continue to remain on the books, that the Biden administration, as an enforcement matter, did not intend to take action to ensure that people were complying with those rules as they were written. That was one part of the important thing that we needed to do, but there were separate questions that still remained about what the path forward should look like and what the Biden administration's approach to this should take. Again, that was all very informed by outreach, and I think it might be helpful for me to spend a few minutes just talking about some of the things that we heard. We had a very wide variety of stakeholders that we spoke to. There were investor advocates, there were issue advocates, people like environmental advocates, labor unions, plan sponsors, corporations, investment advisors, trust companies, kind of all of the major Wall Street institutions that you can think of. And it was remarkable how much what we heard from those stakeholders was consistent. Because if you think of, Eric used the example of State Street earlier in that op-ed. State Street and consumer advocates sometimes can agree on issues, but sometimes don't. And it is quite unusual to hear kind of exactly the same thing from all of the different components of the stakeholder community that we spoke to. And what we heard essentially is that, notwithstanding the fact that those final rules did maybe adopt something that was closer to a middle of the road approach, they continued to have a chilling effect on investor behavior. And what people meant by that chilling effect was essentially that people were thinking about taking climate change, for example, into account, were taking steps in order to better accommodate climate change in their investment decision-making process. And then as a result of the proposal and the final rule in the Trump administration, that work kind of ground to a halt or got reversed. That's problematic in one very significant way. If you think back to the comment I made about Section 404 of ERISA, really this is about what is in the best financial interests of those participants and beneficiaries. What is in the best financial interest of those retirement savers? And so for us to hear that people thought that they had material risks that they wanted to take into account in the case of climate change or other ESG factors, and that they thought that the rule exposed them to so much litigation risk or kind of forbade them from doing so, that was really problematic, because what it meant is people weren't making the best investment decisions that they thought they could. They were leaving risk on the table, or they were taking potential return off the table. And that's a very important backdrop to kind of how we approach these issues, which culminated, as I said, after President Biden's second executive order in May, in a proposal that we issued in October. The process that we go through, a proposal has been issued. It's available for anyone in the public to read. And in mid-December, the comment period will close. And so right now we're in the process of collecting comments that we hope will help to sharpen our thinking and help to answer some of the questions that we asked in the proposal that will lead to a better product in the future. In the same way that the engagement and outreach that we've had to date have been helpful in shaping what the proposal looked like. The engagement and outreach and communication that we get as a result of this public comment period, we're hoping will do exactly the same thing. And there are a couple of maybe big picture themes I want to touch on, just to give you a sense of what you would see in this proposal. The first is, I mentioned that traditionally the Department of Labor had viewed environmental, social, and governance factors as part of this basket of collateral benefits, was this other thing that you needed to take into account. One of the things that we're trying to make clear is that when it comes to ESG factors, they're really no different than anything else that's material. There are times when you should take them into account, and there are times when you shouldn't. That's a very context-specific analysis, but we don't really think that we should be putting our finger on the scale to say, you really shouldn't be doing this. Instead, what we're trying to do is take ourselves out of the middle and put the fiduciaries, the decision makers in the driver's seat, to accommodate these things in the way that, as Eric said earlier, a lot of investors are already doing outside of this legal framework. And one of the things that you can observe is that you have a unique body of investors that are subject to these rules that really are not operating in the same way that all the other investor community are. When you look at the inflows, for example, the amount of assets that are held in ESG funds, Eric, shared some statistics. It really is a very significant disparity between the ERISA and the non-ERISA universe. So one thing that we think is important is kind of removing this negative stigma that has existed in the past towards ESG. That's important in part because, I think as I look at the trajectory of this issue, the very first time I started working on this, the meeting that I had that was kind of my introduction to this issue was with an organization that will remain nameless. It's not one of the panelists, don't worry. But an organization that came in and said, look, this is, at the time it was a Democratic administration. This is a Democratic administration. We know you care about the environment. We know you believe that climate change is real. We think it's really important that the capital that is held in retirement plans is put to addressing these really, really important social concerns. Now, whether or not you agree that those are important social concerns, that's not really the focus of the law that we interpret and enforce. Our focus is instead on what are the financially material aspects of the decision. And I think that's where, to me, there's been so much growth and so much change from that first conversation to the conversations that we had over the course of this year. I will tell you, not one person talked about this as a way to make sure that more capital was investing in achieving, the goals that were recently agreed to in the COP or other kind of goals of that nature. All of the conversations I had, whether it was with investor advocates or Wall Street institutions, were focused on one thing and one thing only: profit and loss. And the concept of ESG as financially material has just changed so dramatically, I would say even over the last 5 years. There are far more tools that are available to investors that measure the kind of risk that they're exposed to. There are far more analytics and increasingly standards to make sure that measurement is consistent across different investment opportunities. And those kinds of changes really are changing, I think, the conversation about what financial materiality means when it comes to ESG factors. I think that's most markedly true in the environmental context, because so much work has gone in to showing the financial impact of climate change. But it's not necessarily only true of climate change. It can be true of any number of these issues. And that really, I think, concept of financial materiality is one that undergirds, again, as a theme, our thinking in this NPRM, because the concept is that these things can be financial material. There's increasingly evidence that they are in more and more contexts. And when they are, in the same way that investors would look at other things when scrutinizing a company and deciding whether to invest, this is increasingly becoming a thing that they have the tools, they have the data, and they have the evidence to look at. So there's a couple of specific changes that I'm not really going to spend a lot of time in, but I will just highlight in the context of proxy voting that, again, this is the exercise of shareholder votes. And again, this concept of moving back out of the space, taking our thumb off the scale and allowing fiduciaries to make decisions in the way that they think is best undergirds our work on that front as well. And what you'll see there is that there's some things that were in the Trump administration rule that we believe had the impact of really forcing people to, or really encouraging people rather than forcing them, really encouraging people to not exercise their shareholder rights. We don't think that that's appropriate. There are times when you absolutely should be exercising your shareholder rights, and there may be times when it's not appropriate. But we don't think that the regulations should be encouraging people to avoid doing that. And so again, what you'll see there is this theme of the Department of Labor kind of moving out of the middle, putting instead the fiduciaries in the driver's seat and allowing people to make the decision that's best for whatever context they're faced with. So with that, I'll stop. I know there are questions and I want to make sure that I leave time for that. And let me just again say thank you to all the organizers for inviting.
Great, thank you so much, Secretary Khawar. So I do have a few questions for you, but thanks for those very helpful remarks. First of all, amongst those who commented on the 2020 rules, we see many investment managers, academics, and advocacy organizations, but many have been struck at the small number of submissions by corporate plan sponsors, given the large number of overall comments, especially given the very large portion of 401k assets that are held in their plans. So I guess the first part of the question is, why do you think so few companies spoke out on this topic? And is it important for the department to hear from these companies?
Yeah, so I think, in our outreach, we did engage a lot, either directly with plan sponsors, with the corporations themselves, or through trade associations. And we got a lot of feedback from that community through that process. I think with respect to the prior rules, one of the issues that I think we're dealing with is highlighted by the slide that you put up earlier, right? When you look at the amount of assets that are held at 401ks in ESG-themed funds versus other parts of the market, direct investment by consumers, for example, retail consumers, or anything else, there is this massive disparity that I mentioned earlier. And I think part of that is because the Department of Labor historically has treated this as another thing. There has been this notion that in order to consider the environmental risk of an investment, by the very virtue of doing that, you're sacrificing the actual return or risk analysis, that it is this other thing that can only be taken into account by sacrificing the financials. I think it's really important that our NPRM puts an end to that notion, because to the extent that these are financially material, it really is part of the core analysis. I think the view that these are kind of extraneous factors is a part of why traditionally plan sponsors have been hesitant to invest, but also hesitant to really engage, because they view this as kind of a more of a niche topic than necessarily it is.
That's very helpful, thank you. And it's great to hear that there is feedback coming to you from that community in this go round, and I guess it's particularly through the trade groups. So that's very helpful. Many of us are concerned with the durability of this rule change and don't want to see it continue to bounce back and forth as it has in previous administrations and over the years. Is there anything in this rule proposal that you're specifically concerned about or thinking about as an important feature of the rule that would have a big impact on its durability?
Yeah, I think, in thinking about that issue, one approach we could have taken would be to be very, I'm not suggesting this would be appropriate, but we could have taken a much more aggressive approach and said, actually, ESG is so important that everyone must consider ESG all the time. That isn't what we did. I think what you'll see is a middle of the road proposal that doesn't say you have to do it all the time. It simply says that where these things are financially material, you should be thinking about them. That concept, I don't think, should be controversial politically or otherwise, because I think no matter what your perspective is on kind of ESG issues, to the extent something's financially material, everybody should agree that getting better returns for retirement savers, that's a good thing. And that's really what we're focused on. And that's what I think the rule attempts to refocus the conversation on.
And do you think that ultimately it will require legislation, changes to the ERISA legislation in Congress in order to put an end to the back and forth? Or do you think that that's not necessary?
I mean, obviously, if Congress passes a law, then the department's rulemaking flexibility is limited by whatever that law says. There are certainly pieces of legislation that have been introduced that do attempt to codify these approaches. Personally, I am confident that this approach of focusing on what is financially material as kind of the core of the inquiry will get us out of this back and forth. Whether or not legislation is ultimately needed, that's a conversation for after someone tries to change it. We find out.
Great. And are there any specific issues or aspects of the rule that you haven't already discussed that for those on this call who are going to be submitting comments that you would like to direct people to, where you are specifically looking for feedback? I mean, obviously, I know that you want feedback on everything that you've put in the proposal, and you've talked about a number of the interesting topics, but you did include in the proposal a number of specific questions. Are there any that you would highlight to this audience where you're really looking for people to chime in?
Yeah, so I think all of the questions that we put in there are any answers that folks have, whether it is supportive of what we've done or not, would be absolutely welcome. I mean, we actually also really do welcome critical feedback because it helps us get to better answers. So I think that's the starting point, that all of the questions. I'm going to name a couple of things off the top of my head. And these are not kind of exclusive. Again, I would focus on the questions that are in the proposal. One thing is we did point to a lot of evidence of the materiality of ESG factors. I think any evidence that people think that we've left out, any particularly important studies that people think we should be paying attention to, whether they point to positive or negative relationships between ESG and returns, would be welcome. We want to make sure that our analysis is really comprehensive. And if we've left out something that people think is important, that's one thing. The second thing I'd highlight is we have this concept of a tiebreaker. So you may have options that are kind of equivalent in terms of a portfolio's needs and equally serve the portfolio's needs. We've traditionally referred to that as the tiebreaker concept. What we said in our NPRM is that once you're at that point and you're choosing between equivalent options, we haven't really put a lot of restrictions on how you choose at that point. It could be anything. It could be an ESG factor. It could not be something that's not an ESG factor. Another question that we asked in the proposal is whether there are certain parameters that we should put around that decision. And I think I'm trying to think if there's anything else I would highlight. Those two I think are pretty important. I think the other thing that I would flag, which isn't necessarily tied to the NPRM, but particularly for those of you that are listening that engage with plan sponsors, represent plan sponsors, or are plan sponsors, anything that you can tell us about, the hesitancy of plan sponsors to adopt ESG would be helpful. That's not necessarily tied to the NPRM, but it is something that we're thinking about and trying to identify how we can how we can work on.
Great, thanks. Just a couple more questions for you, Ali, and then we will pass it over to our panel. First of all, just very quickly, one significant change introduced in this proposal is the removal of specific restrictions on planned default investments, or QDIAs. And can you just explain for the audience, some of whom may not be familiar with what those are, the significance of the QDIA and the nature of that specific change?
Yeah, I think the easiest way to explain what a QDIA is, if any of you have saved for retirement in a 401k, for example, and you're invested in a target date fund, that's what a QDIA is. And the term QDIA refers to another rule that we issued a number of years ago. And it is actually the thing that kind of put target date funds on the map, because the QDIA rule is designed to answer the following question. If you have someone that becomes a new employee, they participate in the 401k, but they never tell you how to invest the money. What are you supposed to do? You're taking deductions from their paycheck. You're putting it in the 401k. What should that be invested in? And so we said that a way to do this is to invest them in these things that are QDIAs. Now, in the Trump administration's final rule, they expressed a lot of concerns about QDIAs being ESG themed. One of the things that we've done in this proposal is to make clear that, as I said, there's a rule that we have on QDIAs. And as I also talked about earlier, there are fiduciary obligations that apply to decisions that investment decision makers are making. So we think those are appropriate and those are the right framework to analyze this. And we don't think that there needs to be an additional scrutiny that's applied if something is kind of happens to be an ESG themed QDIA.
Great, thank you. And a final question for you, one that may be a little bit difficult to give a precise answer to, but the comment period comes to a close on December 13th, which is a date that I'd like the audience to remember. What would be your anticipation for the timing for a final rule?
It's really hard to say. I mean, I would say a couple of things. One is it depends on what comments we get and how tricky they are to deal with, because we welcome supportive comments, we welcome critical comments. They will all help us kind of get to a better answer. But depending on what the comments get, it may require more or less work to complete a final rule. What I can say is, again, I'll reemphasize putting out a proposal in the first 9 months of an administration. That is a signal of the priority we're putting on this issue. So you should expect that that priority level doesn't change once the comment period closes. We will be working pretty hard on figuring out what the answers are and trying to get a final rule out sooner rather than later.
Well, that's great to hear. Secretary Khawar, I want to thank you again for your participation today. It was very helpful hearing your comments. Thank you for joining us. I know the audience really appreciates the opportunity to hear from you directly. And with that, I'd like to turn over this session to Lisa Woll and our panelists. And Lisa, over to you.
Thanks so much, Eric. And great, as always, to hear from Ali Khawar, who's been so terrific to work with really over the last several months. And one thing I just wanted to reflect upon before I brought the panel on is just how different this conversation is than it was even under Obama, where there were relatively few institutions talking to the Department of Labor about ERISA changes, and nothing like the firestorm of letters we got from Wall Street when Trump put out his proposal. And so I think it says a lot both about increasing concern about retirement assets of Americans, but also the increasing asset flow into sustainable investment options and the increasing commercial merit of those to many investment firms who see not being able to have retirement assets invested in these funds problematic. And so there's a lot to talk about. We won't get to all of it today, but I'd like to ask my panelists, Allison and John and Tiffany, to join me. And Eric did already introduce them briefly, but just so that you have everyone's face. Tiffany, if you can just give a little wave, is a shareholder with Reinhart, Boerner, and Van Veuren. Allison Wielobob is with American Retirement Association. And John Hoeppner is head of US Stewardship and Sustainable Investment at LGIM America. So thank you so much for joining us today and for helping educate and engage people on the importance of this moment and the importance of engagement with the DOL through December 13th and certainly after that as well. So just to kick us off, Tiffany, what is your overall legal analysis of the proposed rule?
Sure. Thanks, Lisa. And I'm excited to have the opportunity to talk to you all about this topic today, because I think this guidance is important and will be impactful in providing clarity to fiduciaries about the guardrails that they are subject to when they're making investment decisions. So overall, I think the proposed rule does a really great job of bringing us back to the core of ERISA fiduciary duties, which is the duty of loyalty and the duty of care. And then I think importantly, the proposed rule doesn't tip the scale in one way or the other. As the Assistant Secretary said, it really puts the fiduciaries in the driver's seat. And I think that's important because this rule just simply allows fiduciaries to use their discretion to prudently evaluate how investment choices or an investment course of action is material to investment value. And so what that means is that it allows fiduciaries to treat material climate change and other ESG factors the same way that they would treat any other traditional material risk or return factors. So if a fiduciary undertakes a prudent process and then based on that diligence determines that climate change or some other ESG factor is material to an investment course of action, then the fiduciary can and should consider it. And that's the bottom line. If based on your prudent process, you determine that an ESG factor is material, then you should consider it. That's it. And so it's like the radical application of common sense to this mandate, right? So to me, that's the beauty of the proposed rule, is that it's back to the basics of fiduciary duties, the duty of care, and this duty is forward-looking with a focus on diligence. And so that means that trustees aren't going to be judged in hindsight based on the success or the failure of a decision, but that they're going to be judged on the prudence of the process that they undertook in arriving at that decision. So I like to call that the 3 Ps: process, process, process. It's simple to remember. You have to be thorough, diligent, and unbiased in the way that you make decisions. And then the duty of loyalty, I call this the all about the beneficiaries rule. You have to act solely in the interest of beneficiaries and participants, and then for the exclusive purpose of providing benefits and paying reasonable expenses. And the proposed rule also gets back to the basics when it talks about the exercise of shareholder rights. You have to have a prudent process in evaluating material facts that are relevant to the particular proxy vote or the other exercise of rights. You have to prudently select service providers and monitor your delegations. And then you should adopt a proxy voting policy and periodically review that. So in the exercise of shareholder rights, making sure that you're being mindful of the duty of loyalty, you're acting solely in the economic interest of participants and beneficiaries, and you cannot subordinate their interest for other goals. So
wonderful. Oh, sorry.
Oh, just a couple of other points. So so basically the DOL here is just simply getting back to kind of their long-standing policy that proxy voting and the fiduciary exercise of rights, you have to be diligent and act in the best interest of the plan. So to me, it's simple. The proposed rule is basically saying 2 things. When you're making investment decisions, it's all about the beneficiaries, and you have to have a prudent process. And I appreciate the simplicity of this rule, and I appreciate that it's clear, neutral, consistent with historical guidance, and that it's not unduly complex.
Thanks, Tiffany. And I personally, if we're going to take that radical application of common sense, I think that should be the tagline for all of our responses to the DOL. Really, it's beautiful. Allison and John, anything you wanted to add to that kind of overall reaction to the proposed rule? John, you're on mute.
Oh,
Why
Allison.
don't you go ahead? John,
Okay.
go ahead.
Sure. So my reaction, so first off, we were delighted to see clarification of the nature and the sentiment around ESG analysis. So I think Secretary Khawar framed it right. There's this kind of public tug of war on what does ESG represent. And there's the boogeyman where ESG represents impressing ethical views or social concerns. And then there's the emerging reality that ESG is used for risk and return analysis. And so I think if you look at what's happening in practice, so I think the Secretary said it quite well, when you speak with the investment community and you look at how people are designing products, you look at how portfolio managers are making decisions, ESG is embedded in what they do today already. And many of us have joined United Nations Principles of Responsible Investing that says publicly we're already integrating ESG. And so we're already doing this. So what I saw in the past guidance was frankly pegged to kind of an outdated paradigm of what was ESG. And so as ESG shifts, in the last 5 years, there has been a meaningful shift in the definition of ESG. That's what made me really excited is the clarification of the sentiment of how it's interpreted from a DOL perspective. There's one other thing I'd point out. We were really pleased to see the default language, the Qdia specifically called out. I personally was a little surprised. But I shouldn't have been in retrospect, because if you interpret ESG as part and parcel to risk and return, why wouldn't it be part of Qdia? And that really is the crown jewel of 401k, right? So make no mistake, the bulk of assets are going to go into whatever the default is. So I hadn't really thought about it, but once it was called out, that really was quite important. The one other small point I'll make about the guidance, which everyone in the US has to think really hard about, is there is some specific language around being incredibly clear with investment objectives, where you do have ESG embedded into your investment objective. How do you clarify that? And I think that's going to be really hard, and so it's really, really important to put that right up front. But that will be a challenge for all of us, as we, our group has a huge business in the UK and in Europe, and there's tons of very formal labeling. So I think that's going to be the next wave. So that's another thing on my mind.
Great, thank you. Allison.
Yeah, I would say that, the 2020 rules, I call it, from the one that's finalized in the waning days of the Trump administration, that one discourages ERISA fiduciaries from considering ESG factors. There are no two ways about it. DOL said this proposal is intended to counteract that negative perception caused by the 2020 rule. So that's good, and that is headed in the right direction, absolutely. And I liked what Ali had to say, that, indeed, a fiduciary's duty of prudence may often require an evaluation of the effect of climate change and or, government policy changes to address those effects on investment risks and returns. And starting in 2015, actually, under the Obama administration, DOL said ESG can bear directly on an investment's underlying economic merits. And what I think is positive about that is this has become a premise, or in John's words, embedded in the analysis. It's almost like, duh, of course. My concern here is durability. As a student of ERISA for the last 25 years, my concern is that by turning to some of the phraseology in this regulation is a little bit prescriptive, I worry about it risking, this makes it risk a response by a subsequent administration. And that I worry that, the back and forth that we've already seen on this policy over the last 30 years is not in the best interest of plans and participants, and runs contrary to the needs of a well-considered long-term investment methodology. And so, I do worry. I think it's, like I said, a step in the right direction, a huge improvement over last year, but I worry about the vulnerability and just that it really needs to sort of tease out or sort of be carefully ride the line, to make sure it remains the law.
Yeah, I agree. And I actually have a little bit of a differing opinion with Ali, because I do think there needs to be a legislative change so that we don't keep going back and forth, regardless of how good the rule ends up being that's put into place next year at some point. So I'm curious, you brought up a little bit about concern about some of the language. Tiffany and John, are there any items in the proposed rule that you'd like to see changed or improved? Tiffany, you want to start?
Sure. So one very important thing that we think about when we're thinking about the duty of loyalty is the related duty of impartiality. And so in the proposed rule, the DOL acknowledges the importance of considering the relevant time horizons, but it doesn't explicitly address the duty of impartiality. And I think it would be meaningful to explicitly reinforce the inclusion of long-term investment horizons as the default, and then explicitly recognize the duty of impartiality. It's important to recognize that the overwhelmingly long-term nature of ERISA fund obligations, and to explicitly state that long-term investment horizon considerations should be balanced with short-term needs as well. And I think this is supported by Supreme Court precedent. And then it's also supported by the common law trust, which requires trustees to take impartial account of the interests of all beneficiaries. And there's a lot of research that shows that there's a short-term investment bias and kind of the propensity of investors to discount future earnings. So I think it's important for the DOL to highlight the duty of impartiality and the importance of considering the long term.
Thanks, John. Did you want to add anything?
Sure, it's just a minor point. We're broadly quite supportive, and we do anticipate creating a comment that mimics that. I'll tell you the one area that we are thinking hard about, and the Secretary mentioned as well, is the language around tiebreaker. Mm-hmm. And the reason is that when you use the phrase tiebreaker, you instantly remove ESG from the risk and return characteristics and put it in a different bucket. And there's different ways to think about that. Is it actually a separate benefit, or is it kind of an extension? And it could be very messy. And so we're still working on our language of potential suggestions or how to hone that. But it is an area that we know that is how plan sponsors make decisions, and investment consultants put out tables of, this is the different funds. So that is helpful. But at the same time, I would think there's some potential backlash. So that's something we're thinking about. We haven't got our full views tied up, but that's an area that I think we'll be thinking about in our comment.
Great, thank you. The proposed rule changes also recognizes that the proxy vote is an asset of the plan and should be stewarded prudently. John and Tiffany, do you see this as a reset to the 2016 guidance?
Could continue with the cadence of me going for sure. Yeah, I mean, that short answer, yes. I think generally is a reset back to 2016. I would say the proposed rule is a little bit less prescriptive as the 2016 guidance when it comes to documentation requirements, but the 2016 guidance essentially says that fiduciaries can exercise shareholder rights if it's likely to enhance the economic value of the plan after taking account for the costs. And so that just brings us back to the basic fiduciary analysis, right? Weighing the interest of participants versus the cost and focusing on the net economic benefit.
Great, thank you.
And what I would add there, Lisa, is, and I mentioned this earlier, is that the context of shareholder votes in the past 5 years has changed in practice, right? We've seen a record number of shareholder proposals receive majority support. We've seen a major growth in environmental and social shareholder proposals. We've seen the director vote used in new ways. So there is a magnifying glass on the votes. And so I think it probably, from a legal point of view, may be a reset. But I do think this is early days in how much this asset is used. So I think we have to get it right because, the amount of shareholder engagement or trying to get your clients involved, I mean, this is all going to get quite large. And if a huge proportion of assets are index-based, we're all in a lot of these companies where we want to see change. So,
Right.
I think that the stakes are higher than they perhaps were 5 years ago.
Yeah, and I would suspect that in this year and next year, we're going to continue to see that increase both in the climate proposals and particularly in the social proposals given COVID, racial injustice. We've just seen such a groundswell in that in the last several years. So John, just sitting with you for a minute, why do you think it's important for plan participants to have access to sustainable investment options? And what do you think the impact of this is going to be on the asset management industry?
Sure. So, how I think about it is retirement investments are privileged investments, right? They have taxable benefits. And so it makes all the sense in the world to match this very long time horizon with very long-term risk and build that into the process. So I think just kind of at a practical level, it makes all the sense in the world. If you're a young saver, you kind of want these long-term risks embedded into your analysis. So I think it'll drive, participation with younger savers. I think it's a better risk and return profile. I think a really interesting case kind of counterpoint is our own business. We have a huge business in the UK, and we have a huge business of default ESG products. And I could guess that everyone on this phone or everyone on the web, I would guess a very small handful, even though we're self-selected of being quite interested in environmental issues, I would guess very few people have a default or standalone option today. And whereas in Europe or in the UK in particular, that's a regular practice. Even some corporations have default products in one country and not in the other. So, do I think this will change the attitudes? Absolutely. We did a survey of our own corporate clients, and 77% of them said the number one block to integrating ESG into their lineup was fiduciary consideration. So this is the hurdle. It's not a lack of product. Investment managers are going to build lots of great products. I do think, of course, pricing has to be competitive and all those kind of basic considerations. But it's really this kind of litigation risk that is what is holding back what I think is this kind of next adoption. So I think it's
So we probably are going to see quite an upswing from the handful of target date ESG funds that exist right now in the ecosphere to, I would say, multiples of those. I mean, that's what I'm expecting for 2022. So, and Tiffany and Allison, does this proposal, assuming it becomes a rule, provide plan administrators and fiduciaries with enough clarity to begin offering sustainable options in their plans? Do you expect that to happen rapidly? Allison, we'll go first with you. Changing it up here, Tiffany.
I think so. I think that's their intent. I think they've kind of yes in some ways, but not in the others. In a way that I think that the clarity is lacking, and in a way it's not entirely up to DOL, because if the intended implication is that fiduciaries should be considering ESG, climate change, and all of it in the context of investments, then there continues to be no clear agreement from the regulator's perspective, and perhaps in the regulated community, on common definitions and nomenclature. The SEC is now working on such a project, their taxonomy project, and as a consequence, I think there's a lack of consensus, I would imagine, and I hear, on how to evaluate the investments. And so I understand, talking to some of our members at ARA, the same investments may produce different results under Morningstar and MSCI. And so I think that that's an impediment, a long-term one, not in the short term, certainly. I think that, like I said, a lot of obstacles are moved out of the way, but this is something that's sort of more of a macro issue that's going to have to be addressed.
Thank you. And Tiffany.
So I wanted to raise my hand when the secretary is asking the questions about why ERISA plans haven't there hasn't been an uptick in ESG investment, and I think it's really just the uncertainty that has existed for 30 years with this shifting pendulum of guidance over the years, and I think it's caused this collective inaction because a lot of investors are just waiting to see what happens. And then also because part of the duty of prudence is that we look at peer practices. And if you're looking around and nobody else is doing it, then that's a part of the analysis that you're looking at it. So I think because they've been so unsure about what the guardrails are from a fiduciary perspective, and because they're not seeing their peers really participating that way, they've simply kind of been in a holding pattern waiting to see what happens. So I think this new rule will empower them because it's very clear that they can make decisions about ESG the same way they make any other investment decisions, and they understand that guidance.
Great. Well, I know Eric wants to wrap up, but if I can ask you each in 30 seconds or less to say why it's important that the 200 plus people who are on this call today send a letter and communicate with the DOL.
Oh, can I start, please?
You can.
I feel strongly about this in the context of ESG and otherwise. I was in the reg writing office that writes these regs. I was there for 10 years and I heard over and over the dissatisfaction with a certain regulation, and routinely I'd say, well, what did your comment letter say about that? And people would say, well, we didn't write one. It's like when people about an elected official, but they don't vote. You have to say something. And that's what Congress delegates rulemaking authority to federal agencies in certain cases. And this is one of them. And that's intended to ensure that the public has an opportunity to participate. This is the administration.
Thank you.
Yep. So please,
Great.
right? Okay.
John and Tiffany, you want to add anything to that?
I'll make it brief. Yeah, we're submitting a public comment. We've commented the last few. It's always hard. You feel intimidated writing these formal legal, but we just try to put our best thoughts of what makes sense and what doesn't. But it's not as painful as it sounds.
Tiffany.
All comments obviously are helpful in providing guidance to the Department of Labor, but also because of anticipated litigation with any issue like this, supportive comments are also helpful in the face of any legal challenge.
Wonderful. Thank you to my panelists. Thank you for providing so much great information in a pretty short period of time. And Eric, over to you to wrap up. Thank you.
Great. Thank you so much, Lisa. And thanks to all of the panelists for such an excellent presentation. We convened this group to stress the importance of submitting comments and creating a strong public record for this rule, as the panelists were just discussing. We have shared two versions of a template letter with you that you can use as a basis for your presentation. Those are available via the links in this presentation, which we will be emailing to you afterwards, and also on our DOL landing page. You can see the URL at the bottom of this slide. And USIF, I believe, will also be sharing a toolkit via email for those that are looking to submit a comment letter with some sample language and instructions for submitting a letter. Next slide, please. So we appreciate the fantastic partnership of EDF and USIF in making this happen today. Thank you so much, Lisa, for leading our panel. Thank you to all of our speakers, Allison from the ARA, Tiffany from Reinhart Boerner, and John from Legal in General. And a special thank you to Secretary Khawar, whose leadership we deeply appreciate. Finally, thanks to all of you for joining us today. We have an enormous opportunity to help protect the savings of 140 million Americans and to make a difference on climate. There are 26 days left until the comment deadline, December 13th. So please reach out to any of us listed on this slide if you have questions, or we can be helpful to you as you prepare your comment letters. And with that, we conclude the webinar. Thank you very much for your attendance.